Well, we're seeing some green shoots going forward, so we're hoping the worst is behind us. As you know, April and May in particular were very difficult trading periods for us. We had two things happen to us. We had the impacts of COVID-19 taking demand out of the market, and then of course you had the disagreement in OPEC +1 with respect to oil supply. So we had supply flooding the market at the same time demand was falling away out of the market, and that really affected prices for us. We're seeing a normalisation now of things, so supply demand is starting to become normal again. It's not where it was previously, but equally there's been a lot of supply go out of the market as well. So look, fingers crossed at the moment, Ticky, but at the moment we can see some green shoots.
I guess there was some surprise at the size of the amount of production exposed to the LNG spot price at about sort of 25%. Would that be right? And can you pull that down?
It's difficult for us to pull it down. So we always have an amount of spot sitting in our portfolio simply for operational reasons. This is a manufacturing process, as you know, and the ships have to come in and out. They've got to sail long distances. So we need to make sure that we've got a bit of flexibility in there. So we always keep an amount in there. That's typically, we target the 15 to 20% range. What happened to us in the second quarter of this year is when we set our contractual requirements for the next 12 months with buyers. So that was April. That happened at the same time that demand was going out of the market. So the buyers exercised their contractual flexibility and said, look, we just don't want those cargoes at this point. Now, going forward, they have no further flexibility left. So we've got certainty again, as I said, there's normality now coming back into the marketplace.
Yeah, well, you had record production, I think, and you beat expectations in terms of your underlying net profit. Costs were quite high, though. I think 200 million in operating costs at a time when you were trying to bring them down. I guess that again is COVID, is it?
Well, there's two parts to that. So firstly, yes, the operating business did extremely well through extenuating circumstances. Our workforce is a mobile workforce, so they were dislocated from their families. There was an extended period of time where they really didn't know when they were getting home and how they were getting to work itself. So that was difficult. We had to put them in a cocoon, Ticky. You think about it, a lot of our facilities are like a passenger ship. You kind of work and live in a confined space, and so we had to take extreme measures there. But with respect to the costs themselves, look, I've seen some of the numbers with the analysts. They're actually not correct. There's a part of it is due to Forex, part of it is due to COVID, so there's no doubt about the fact that COVID has affected our costs. But equally, we've pushed some activities out into 2021. So I think we'll get some further clarity on that over the next few days.
Now, in happy news for shareholders, you declared a 26 cents a share dividend. That's a payout ratio at 80%. That's quite significant, I guess, for shareholders in these times.
Well, look, our commitment is to get the cash back into the shareholders' hands, and we've said that. At the moment, we've gone through our cash preservation mode. We did the really difficult things. We cut our total spend for this year by just on 60%. So as we look at shareholders are already sharing some of the pain with us because our dividend is based on our underlying profit. And so that's already come down. To cut the payout ratio again would have been a double whack for shareholders, and we just fundamentally don't think that's the right thing to do. Okay,
now you've got some very exciting opportunities sitting on in your in tray, Peter. One of which is Senegal, which I think you've got 9 days to exercise your preemption, or Lukoil, which is a really interesting Russian business which has got US sanctions on it, and presumably you wouldn't like them, surely, as a partner. What are you going to do?
Well, we've got two things potentially on our plate, Ticky. So if you look at how things have changed even in the last 6 weeks, we've got obviously the Senegal announcement and our project called Sangomar there, and Lukoil wishing to take Cairns equity there. And of course that we have a preemption right. A preemption right is basically a right to match the price of that particular deal. We've got 30 days, as you quite rightly stated. We've got 9 days to opine on that.
They're paying up, aren't they? They're offering quite a strong price.
Well, I'm not going to indicate whether I think what the price is, but at the end of the day, we've got 9 days to consider that. And then, of course, Chevron in the same period has indicated that they wish to sell their equity stake in the North West Shelf. Now, that decision won't be until sometime early next year. But here you are, Woodside's now got 2 opportunities on its plate that we didn't have 6 weeks ago, so things have changed very rapidly.
Yes, and do you think you might get a tolling deal out of Chevron before that decision by the end of the year?
Well, we would hope they're motivated to do that. We've been focusing on what we call early ORO, or early gas coming in before browse. Those agreements are pretty well advanced at the moment. So we're hoping to get some gas out of our facilities and through the acceleration of Pyxis, and then of course there's some other gas owners who wish to get it through. So that'll fill the near term. The longer term with browse, we'll get back to the negotiating table in the next couple of months. So who knows? We'll see how that goes.
And I suppose the whole idea about balancing your dividends and your acquisitions, and then potentially how you develop Scarborough, how much investment that you put in there, they're all moving parts, aren't they, going forward?
Yeah, there's a lot of moving parts, and it's all about managing the balance sheet and cash flows. So our balance sheet position is very good at the moment, but we need to preserve that. Our credit rating is strong at BBB+, and it's something that we cherish. So we'll also be watching that very closely. And then there's all these opportunities we have, and so it's the old story. You can have everything you want, but not all at once. And we'll have to work our way through just how much equity we wish to hold in these projects, and then which projects that we'll target.
Yeah. Peter, what's this all doing to our national economy? Because, of course, LNG was the great hope in terms of our next major export industry, and obviously a lot of these major projects are now on hold, potentially in question.
Well, I think it's it's a good indicator of the strength of the economy, Ticky. If you think about it, typically LNG pricing lags the iron ore industry or the other commodities by a couple of years. If you think about when the great growth periods come through, so iron ore's having a good run at the moment, where we see the fundamentals for LNG starting to pick up in the second half of 2021 and really starting to take off in 2022 onwards. So if you think about that lag time is about right. And of course, that's all good news for the government. Now, of course, the government hasn't built that into their forward estimates, and nor should they. But I would say the fundamentals are starting to work in our favour. Let
me ask you about digital, because that was something that you were spending quite a lot on in terms of your own time and also obviously investment. I think with IBM on both AI and quantum. Are you still looking at that to help drive your costs down, and in what way?
Yeah, look, we really are. So digital's been a tremendous platform for us. And if you think about it just in the context of COVID-19 and dealing with it, almost overnight we were able to move our entire office-based workforce to home-based working. And that was very effective. So that's 3,000 people we basically moved out of this facility here in Perth, moved them home, and almost overnight they were hooked up to a digital system. And we were working through WebEx very quickly. Some numbers out there, we're having almost 2,500 meetings per day through that workforce. So digital helped us in that regard. It also helped us as we looked at our contingency planning for our offshore assets. And so we're now able to run some of our offshore assets remotely here from Perth. They were things that we thought were going to take many months to put in place. We turned that from months to weeks to actually days. And so we're now able to run those facilities. That's going to help us as we go through cyclones in the future. And of course, we've got a lot of work in robotics and AI. Robotics is really interesting for us at the moment as we think about taking people out of hazardous areas of our plants and what sort of work robots can do for us.
Finally, what have investors been asking you, Peter?
They're really asking me about what's the future look like. I think investors understand why we took our write-downs. They understand now that the balance sheet is a very robust one with respect to our asset valuations when you look at the pricing that we looked at. So that provides an excellent platform for us now as we go into growth. But they're really looking forward. Tell me the inflection point. When should I be starting to invest and understand that some of these growth prospects are going to be real? And what we're saying is, first thing first is commodity prices need to firm up. We need to get a line of sight to that. We're already starting. Q3 is really, really important for us, Ticky, to see that supply-demand balance get back into the right shape. And then if we can put 2 or 3 quarters like that together, then I think you're going to see investment start in a very significant way.